Welcome back, everyone, to another episode of Happy Half Hour. Toby Weber, Nick Sherman's talking markets, life, and the lighter side. So today is Tuesday, September 3rd. I hope everyone had a nice Labor Day. School starting, fall's in the air, although we're getting like 3 days of 100 degrees, which is kind of confusing for this time of year. So Toby, what's on your mind? What's on your plate? What are you looking at?
Coming back from Labor Day weekend, which was a nice little break. Kids, as you said, are in school. Markets have been a little more interesting in August, a little more volatility. And as we start September, perhaps that continues. So a lot of interesting and fun stuff as we head into the fall season. So I'll start with kind of a softball, kind of get you warmed up. Talk a little bit about how Pure is using artificial intelligence, if we are, and what we use it for and how we think it may benefit us moving forward as well as our clients.
I've kicked the tires on a lot of AI technology. And as a caveat, the SEC is very interested in how advisors talk about AI from a marketing standpoint, from an investment standpoint. A few firms have gotten slapped on the wrist for touting their AI capabilities as it relates to selecting investments. That's a big no-no. Okay, so we have to be very intentional about how we talk about it. However, we've focused more internally on how we can make our advisors more productive via AI tools. So we've contracted with two separate providers. One's more investment focused, one is more generic and planning based. So if we get a client question, if we have a question about the prospects for an individual stock or what happens if X candidate wins the election, we can plug that into AI and not get an answer that we just parrot back to clients, but it'll help frame the argument or frame the question in a way that you can make your own. So long story short, we're using AI to make our advisors a lot more productive on the internal end, operationally, marketing-wise, just to streamline those back-end processes, to free us up to focus on what matters. That's investing the money, talking with clients, running financial plans. That's much more important than some of these manual tasks that can be automated, so to speak.
And I realize it's early days, but what's your impression so far? Are the tools ready for prime time? Are they a little bit green? How do you see the tools working so far?
Somewhere in between. They were a little rough when it first launched back in November of 22. Now I feel like the rate of improvement is exponential almost, where almost by the week, these models are getting smarter and better. And that's the premise of AI, is to learn. It's a language model that learns. So as additional data gets fed into these models, it gets better and better. And you can actually train some of these models to scrub your own website, scrub your own blogs. And that's one thing that we're working on, is training models to talk like we do. So I've got 7.5 years of blogs and podcasts and videos. If we feed that into the model, the output should be better. So again, a short answer to your question is they're getting better. I don't think they're a finished product yet, and no one is copy and pasting what AI says and sending it out to clients. It's more to formulate a thought.
One more question on the AI, and it's kind of switching gears to the investment side. A lot has been written, a lot has been spoken about that AI is a step change. It's sort of like the internet back in the 2000s, and that this is, the world will never look the same again from an investment standpoint. Others say that there's a lot of overbuilding going on in the AI space, and that a lot of this will turn out to won't bear any fruit, but people are spending the money anyways just so that they don't fall behind. Where do you come down on that argument, or do you even care?
I care, but I can't pretend to know what the end game looks like. I'm not an AI expert, but there are some parallels with the internet boom, right? Like back in 1999 and 2000. A company that sells pet food could put .com at the end of their name and the stock would go up by 1,000%. Now, the difference today is a lot of those companies in 1999 didn't make any money. Like, they didn't have a business that was generating cash flow. Today, that's not the case. But then when you look at these profitable companies that are profitable in non-AI areas, plowing billions and billions and billions into AI, at some point investors want a payoff for that. And right now, there's not a proven AI revenue model. It just doesn't exist. It's more internal, increase your productivity, but there's not a company out there that makes money based off their AI technology. It's all on the investment end right now. And it's certainly an arms race. That's the $1 million question. Is there a payoff at the end of the road? Because right now, it's too early to say that there has been a payoff.
Yeah, I thought it was interesting. The CEO of Google, and it was either Meta or Microsoft, basically admitted as such that they don't really know the end game, but the risk of not investing was greater than the risk of investing and finding out, hey, we went too fast. So I thought that was kind of an interesting comment by the people that are driving some of the spending.
Well, and then you look at the regulation side, government's involvement. It kind of reminds me of cryptocurrency, where the government was paying attention, but it's so complex and it moves so fast. There's not a regulatory framework around it. And I think you've seen some of the deep fakes and the copying of voices and all these bad actors when they get their hands on AI. It's certainly mostly good, but it's also some bad. And there needs to be a framework to regulate it because there's too many use cases that aren't good for the general public.
Okay, good stuff.
So Warren Buffett, everyone tracks what this man does, and it doesn't seem like he's slowing down at the ripe age of, 85 or 86? He still works a lot. Buffett has been selling stocks the last 6 months, and now I believe he holds the highest percentage of cash that he's held over the last 20 years or something like that. Do you read anything into that, or do you just kind of shrug that off?
The key to his success has been how long he's been invested, how long he's been able to compound. Obviously, he's bought good companies and ridden those higher, but I don't think he tends to be very active. I think he tends to think out what direction he wants to go. And I wouldn't make any investment decisions based on what he's doing, but I think I would take note that he's got $260 billion in cash today and seems to be continuing to sell, whether it's Apple or Bank of America. So I wouldn't make any investment decisions based on that alone, but it is interesting that he's choosing this time to raise such a significant amount of cash. But there could be a dozen different reasons for that. And only one is, hey, he thinks that there's going to be opportunities to put that cash to work at better prices at some point, in the not too distant future. What do you think of it?
Yeah, I think that's a good way to put it. What most retail investors do when they see that is they try to draw a line from what Buffett is doing to what they're doing. And Buffett's playing a different game than almost everyone on the planet. He's controlling large pools of capital. He's the outright owner of the majority, a lot of these huge companies. He's put the management teams in place. So he's playing a much, much different game. But I think I saw his preferred measure for how attractive the general market is total market cap of the U.S. stock market. So the total worth of the overall stock market divided by the GDP of this country. And it's historically stretched. And actually this week I'm blogging about something that I blogged about a couple years ago, the best metric to predict future stock returns. And I wrote this blog I think in 2019, but it by far got the most views out of any blog I've ever written. It was like 15,000. And the best predictor for future stock returns is the percentage of U.S. households that own stocks. So I chose this topic last week, and over the weekend, the Wall Street Journal, a couple other folks published this metric that 42% of U.S. households own stocks, which is the highest percentage it's been in like 15 years. So I don't know if that was odd timing or what, but it seems like the American public is bullish and optimistic on stocks, which, as we've pointed to in the past, is not a good thing for future returns. I'm not saying that's going to hold this time, but it's something to pay attention to.
Well, one last thing on Buffett. I mean, he built a pretty sizable Apple position, and he built it at a pretty favorable price. The stock went up 2 or 3x, maybe even 4x since he bought it. So all of a sudden he had a Apple position in his portfolio that was dominating. I think it was like 40% of his portfolio was in one stock, which any portfolio manager will tell you that's aggressive. And so he was going to have to wind that down at some point. And so I think he's also being opportunistic and choosing to kind of wind some of that down while the market is still, positive versus waiting and having to do it, from a lower exit point.
Well, and I think the other part of this that can't be understated as it relates to Buffett or anybody that's allocating capital. Now there is an alternative to equities where I can sell a stock that I deem to be overvalued, and I could park it in a short-term treasury, get 4 to 5%, and just wait. So investment decisions aren't made in a vacuum. We're constantly looking at the evolving opportunity set out there and making an asset allocation decision. And I think Warren Buffett or anybody else is saying, okay, now if I'm uncertain or I might need this cash, I can park it in a money market and get a reasonable amount of return, which hasn't been the case for 15 years.
Well, and I read something that he's either the number 1 or number 2 holder of treasuries across the board. So he's obviously following that advice and parking it in treasuries where he's making close to 5%, if not more. So
last thing on Buffett. So I have someone in my life that always sends me notes about Buffett hating bonds. Buffett shuns bonds. And I chuckle because Warren Buffett sells these huge blocks of stock, billions of dollars, and parks them in bonds. So the media often spins stuff and creates these headlines that really aren't true when you look at actually what's happening.
Okay, I got one for you. So I think I sent you a chart on this. So, Nick and I will, if we find an interesting chart in our readings, we'll send it back and forth to each other, stuff that either confirms what we're thinking or presents a different idea on what we're thinking. And so I sent you one on sector valuation that looked at the different sectors of the S&P and how they're valued today. And the takeaway I had from that chart was that technology is really the most overvalued, which makes sense given the pretty remarkable run it's had recently. But that if you looked at the rest of these sectors in the S&P, they were overvalued. It wasn't by a very large amount. Then energy, I think, was one of the ones that was significantly undervalued. And it's looking at historical valuations. So it's comparing where they are today to historical valuations. Wondered what you thought of that chart. I know you were thinking about maybe doing a blog post on it, but curious as to what you took from that.
Well, it's consistent with what we've been saying for the last 1 to 2 years, where it's been at the sector level, it's been technology and everything else has lagged. And then you can even take that a step further. It's been U.S. large cap driven by the technology stocks and everything else has lagged. So when I hear people say the market is stretched and it's overvalued and nothing's attractive, the counter to that is there's some beaten down asset classes that have been out of favor for a long time. And again, if you're looking at the future opportunity set, it might be a decent spot to rotate out of what's worked, that's U.S. large caps and technology, and start to allocate to some stocks that are out of favor. And what's out of favor? Basically every other U.S. sector from an asset class level, small cap. I think small caps are the cheapest relative to U.S. large caps they've been in like 30 years or something like that. Real estate, small cap, emerging markets, foreign stocks. So there's all of these not beaten down, but out of favor, lagging equity asset classes relative to U.S. large cap. And I think it's hard for investors to wrap their head around not owning something that has done really well over the past year or 5 years or 10 years. And I think that recency bias, basically overweighting what just happened, is probably one of the most dangerous biases that investors get sucked into. We've had people approach us and be like, why don't we own U.S. large caps or more U.S. large caps? Or why don't we go all in on technology? It's like, well, that works until it doesn't. And there's no waving yellow flag or red flag that tells you when things turn. Look no further than the month of August, the first part of August, the end of July. I think the NASDAQ was down about 10% in a matter of 4 or 5 trading days. So it's great to crowd into trades that have worked, but on the flip side, if you're retired or if you need to preserve your pool of capital, the days of the wealth-seeking mindset and trying to squeeze every ounce of return out of your portfolio are probably over. Now you should be more prudent and measured and be mindful of risk. I'm doing a video today about unpacking risk and how to look at risk in your portfolio because every investor can tell you how they're doing from a performance standpoint. Almost no investor and no advisor even can tell you how much risk they're taking. And I'm trying to get people to get ahead of that before it's too late.
It's a great point because as we saw in 2022, as we saw in August, the areas of the market that are the most stretched when the market goes the other way, those tend to be the areas that retreat the hardest or go down the most. Doesn't always happen that way, but we saw that in recent times and that could be the case. The other data point that kind of drove this home for me, I was doing some research for a client meeting and the client owns Microsoft. And so I found a chart that has the annual return for Microsoft stock back to 1987. So I printed it out. I thought it was interesting. But over the last 10 years, every year it's up 20, 30, 40, 50, 40, 20. And then in 2022, it was down 30%. But every other year is up double digits, and in most cases up 30 or 40%. So just a tremendous run, which has benefited all of our clients, but it's probably a little bit on the later innings in terms of being a bit stretched for valuation.
Well, and most folks, I've talked about this before, but if you're an investor, most people have some exposure to the S&P 500 or a large cap index, which is great. Then they own a lot of the top 10 holdings outright. So you get this double exposure to tech and the AI themes. And it's not the worst thing in the world because that certainly worked. But when you look at the other side, like a 2022, we found a lot of prospective client portfolios, a lot of investor portfolios did a lot worse than the S&P because they were triple exposed to a lot of these hot themes. And it's like a rubber band. You know, it gets stretched and stretched and stretched on one side, and it often snaps back violently on the other. And that's what we're talking about. And it's okay if you know you have those risk exposures, but a lot of people have no clue because a bull market hides a lot of warts. They're often exposed when the rubber band snaps.
Yeah, nobody goes back and digs into the amount of risk they're taking in the portfolio when it's going up 10, 15, 20% a year. It's only when, you know, as Buffett says, when the tide goes out that you find out who's been swimming naked. So
that's right. That's your favorite Buffett quote.
Okay, I got another one for you. I'm on a roll. So you had a chart in the August month-end video that you did. And it talked about seasonality. And I think the gist of the chart is that September and October aren't the greatest months of the year if you look at history, especially during a presidential cycle. Maybe expand on that a little bit and whether you believe seasonality is something that people should pay attention to or do anything about, or it's just one of the quirks of the market and we just have to take it in stride.
Yeah, so I shared that chart, and I believe the data was as of 1950. And it was showing S&P returns during an election year by month. So September, October, there's some seasonal weakness. In a previous blog post I did at the end of last year, we highlighted stock returns during every election cycle since the 20s. And it all follows a similar pattern. As we get closer, 60 to 90 days out from the election, markets can be a little squirrely. The rhetoric heats up, the narratives heat up, the media sensationalizes everything. The candidates are debating. The markets do act squirrely. Stock prices do go down. Something interesting happens after that. And again, this is almost 100 years of data. Markets bounce back and they go up post-election. And the volatility, the price movements of stocks goes back to normal levels. So I'm not saying this cycle is going to follow suit, but it wouldn't surprise me. You know, I'm already starting to get more, election type questions. Even though we've tried to get ahead of all this and try to drop history, everybody thinks this time is different. So I'm kind of a nerd. So I did something. I was talking to my wife. I Googled presidential headlines from the election in 2016 and 2020. And I hid the date on all of these headlines. You can't tell the difference between headlines from 8 years ago, 4 years ago, and today. They're all the same. They're all the same. Yet everyone wants to pretend like this election cycle is the most important in history. And if this candidate wins, we're going to hell in a handbasket. Every election cycle is the most important ever. The media wants us to engage. That's how they get it. They sensationalize everything. And I'm getting, I had a ridiculous conversation where someone wanted to meet before the first debate, the first presidential debate, meet after, and then dissect the portfolio and see what changes. It just threw me off because that's not how a sound investment process should work. History's not riddled with those that get emotional about politics and investment success. So know that this emotion, this cycle, the headlines, it's all normal. Post-election, we're all going to go about our daily lives. What you do on a Tuesday morning is not going to change depending on left, right, or middles sitting in the White House.
Yeah, it just underscores how effective scare tactics and the marketing and the media are, because you have clients and prospects that are worked up about this stuff, and it's because of they're being inundated with scary stories, scary headlines. If this happens, that's going to be terrible for everybody, and people are just get sucked into that, unfortunately. And I think our job is to try to help them separate the signal from the noise and focus on their long-term objectives and stay the course where that makes sense, rather than, be overreactive and respond to every headline or debate outcome or anything like that. So,
well, and if there was a perfect case study on why politics and investing do not mix, it was 2016. I mean, that was an absolute S show for those that project and predict what happens, not only in the election outcome, but what happens to markets. They were 0 for 1,000, where the candidate that they said was going to win, that was like a 90-something% favorite, did not win. And then they said, if Trump wins, the market's going to tank, okay? And I'm not saying the market went up because of Trump or anything like that. But just because you think you know the impact of an election on markets that doesn't necessarily mean that it's going to play out that way. So they were 0 for 2, and it was a major swing and a miss. That should be a case study for everybody out there. Politics and investing do not mix. Even if you knew which candidate was going to win, that doesn't mean the market is supposed to react the way that you think it is. Markets don't care about politics as much as people care about politics. It's a whole dose of human psychology, the media, having an information filter in what's out there. And I always point to people today, like 2024 is the best performing year in an election cycle year, if that makes sense. So markets are forward looking. It's not like the market is surprised about an election. It's going to wait for the outcome and then react. It's reacting right now. It's sniffing out who they think is going to win. And then after the election, if history serves, everything will go back to normal.
Yeah, I read an article over the weekend that touched on this, and it said, if this happens, Democrat, this happens, Republican, guess what? After the election, everything calms down and the market tends to move higher. And he said, no guarantee that's going to happen here, but why does the market move higher? He said, because the market normally moves higher over time. So he's like, I don't know why we have to ascribe a reason to it. He said over time, the market moves higher. And so once you take that uncertainty out of the way, the market, it's not surprising that over time, more often than not always, more often than not, the market will resume its course and look to move higher, moving forward.
I think there's brilliance in those comments because they're simple, but simple doesn't sell. Like if I went on CNBC and said stocks might go down, but they're probably going to go up, especially after the election, and they're probably going to go up over the next 30 years, mostly 10 to 20% of the time stocks are going to go down. That's really hard to distinguish from being an idiot, but probably the most likely outcome. But it sounds like I'm aloof to risk and I have my head in the sand. Sounds overly simplistic. It's hard to discern simple advice from being a moron.
Yeah, you would not be invited back.
I would not be invited back because that doesn't sell.
Right.
Simple doesn't sell. Okay, I got a question for you. When's the last time that you wore a suit? Funerals don't count.
Wedding count?
No. Business related.
Oh man, business related. A suit, not a sport coat and a dress shirt.
Full tie, salesman. You have insurance contracts in the vest of your jacket.
It's been decades. When I was ESCO, not too many people know this, but I was part of the group that pushed to have casual Fridays and casual dress because I just didn't see the reason to wear a suit or wear a tie or anything like that. So I helped convince ESCO management that we needed to be able to dress casually. Now, there's always pitfalls to that. Some people dress a little too casually, but even weddings and funerals, I have a hard time, getting dressed up and wearing a suit for those, especially if, sometimes we'll go to a wedding and it's 103 degrees and people are there in tuxedos and suits. And sometimes I look at it and go, what are we doing? Like, I understand you all look nice, but this is ridiculous. And who are we doing this for? So anyways, there's my rant on tuxedos.
I'm right there with you.
Suits.
I wore a suit every day, and I'm not exaggerating, every day for the first 12 years of my career, and I rode the Max to work. So suit plus Max plus August heat plus crowded train. I'm pretty sure a part of me died every day. I had to strap that piece of cloth all the way up to my throat, down to my feet, and I will never, we have a rule up here. If you wear a suit, you're fired. We do not wear suits. We'll never wear suits other than a funeral or a wedding. I think the suit and tie is the most antiquated wardrobe thing that still exists.
Yeah, don't underestimate the tie. The tie might be the stupidest piece of clothing ever to come down the pike. There was a day where that was considered normal dress, an appropriate dress, but you think about it, let's take a piece of fabric and strap it around our neck and tie it really tight because that'll look really good and people will take us really seriously. I just have never understood that. So I got one last question for you. I think we're getting close on time. So headed into the fall season, I know you got a lot of activities in the fall. What are you looking forward to most? What are you excited about as we get to fall?
Well, I coach soccer. I coach 7, 8-year-old girls soccer. And this year's the first year where we have refs. We have free kicks. We have throw-ins, 7-on-7 versus 4-on-4. There's goalies. My little guy is 5. He started kindergarten. So he's riding the bus with his big sisters. My oldest is a 5th grader, so she's at the mountaintop of her school. Next year, she'll be in middle school. So I've got both ends of the spectrum. I'm just happy and sad to see my kids grow up because it does go quick. Like every parent says that, but it really is true. When sports start, when school starts, it really is a whirlwind. I just try to balance it out the best I can and be present. So that's what I'm looking forward to. Just being present and immersing with my kids as they grow up. You?
Yeah, I think that's well said. I've got, as you know, 5 kids, but 2 of them are in high school, including my daughter, Maggie, who is a freshman at Westland. So, there's a lot of anxiety around going from big fish in a small pond to, small fish in a big pond. And so we're kind of navigating that with our kids. But you do realize, we have 5 kids, and within about 4 years from now, they'll all be out of high school and out doing their thing. So it does go way too fast, and you just try to find the moments where you can enjoy with them and enjoy what they're up to and be part of it if you can.
All right. Well, that's good stuff. Thanks for tuning in. Another episode of Happy Half Hour with Toby and Nick. If there's any topics or feedback that you have for us, send us a note at insight@pureportfolios.com. We'll see you next month.